Richard Lehmann, thank you very much for joining us. Why don't we begin with a couple of macro questions. One is the largest central bank in the world, the Federal Reserve, and not to mention other central banks, very, very influential in economies now sort of in the credit allocation business. Some have said the Fed now has created its own sovereign wealth fund. But you say, despite all the rhetoric of the Fed saying they're there to help we the people, they have two not so hidden agendas that they don't like to talk about. What are they?
Well, thank you for having me. And yes, I think the highest priority of the Federal Reserve Bank, and as they really should be, given that they're really a government entity, is the maintenance of very low interest rates at which the U.S. government borrows, since it's the biggest borrower in the marketplace. So keeping those rates low is a number one priority. And secondly, the need to have a strong banking system, which means in certain respects giving them certain advantages that helps build up their balance sheets. And that one is probably a necessary one, but not one that the public has much sympathy for.
Explain the carry trade and how the Fed helps the banks.
Well, we can go back to QE2, which was a case where that was a little more blatant because the banks should have gone out and issued more stock to make up for the losses that it took in 2008. But they didn't want to dilute their equity, and because their stock was trading so much below book value, they resisted that. And so the Fed lent them billions of dollars, which they employed in buying U.S. Treasuries and paying the Fed negligible amount of interest. So this was a definite positive way of them earning money. And then when the Fed decided it was time for them to get back in the lending business, they came up with QE2 and said, it's time for you to get back into the lending business, but we'll take you out at current market rates. So we're going to be buying $500 or $600 billion worth of U.S. Treasury debt, which is roughly what was estimated was being held by the banks at that time. And that prevented a spike in interest rates when they made that announcement.
So how is the Fed trying to help now with the banks?
Well, this time around, the carry trade, of course, built up again because the economy didn't pick up and lending didn't pick up. So the banks went back into this. But this time, hundreds of hedge funds and such joined in the fray, and so the carry trade bubble now is probably in the $1 trillion range or higher. So the Fed's really not in a position to take everybody out, and so it said, okay, we're going to start tapering our buying of securities, and we're giving you plenty of time here to start reducing your position. But this has caused, of course, a great degree of volatility in the market, because there are people who took them at their word and started selling immediately, and then when they saw that the Fed wasn't going to get real tough, they held off. So we still have that big bubble hanging over the market.
In terms of, we'll get back to that, but in terms of what the Fed has done, if anyone had said 5 years ago they were going to do what they did to their balance sheet, we would have expected Weimar Republic, German-style inflation. It didn't happen.
Yeah.
Why?
I think that it proves that Milton Friedman wasn't exactly right in terms of saying that the printing of money is a major cause of inflation. That there are other mitigating factors, and the velocity of money isn't there because the economy isn't moving. So the multiplier effect of all this pumping of money hasn't happened. But that doesn't mean it isn't sitting there on the periphery waiting for the economy to pick up.
So the gunpowder is still there, waiting
That's
for a
it.
match.
I mean, the fuse is still burning.
And has that created a bubble in the stock market?
Yeah, the Fed policy has basically punished anybody that wants to invest into fixed income, and therefore, especially things like pension funds, which have 7 and 8% earnings assumptions, have had to go into the stock market to try to boost up their earnings, because otherwise the companies would have to dramatically increase their funding requirements, and that would be a real downer to the economy.
You've made note, maybe you could share it with us, that with the easy money, large companies find it easy to borrow at a very low rate, and this has led to stock buybacks. How much stock buybacks have there been since the middle of the last decade?
It seems to be a major activity, and it makes sense in a certain context that if companies aren't growing and or even shrinking in their sales, then they're throwing off cash, and buying back their stock it makes sense. But if you look back in history, it always seems like they're buying at the peaks or near it, rather than when things are really cheap. So
how much of the stock buybacks do you think has inflated the market?
I don't think that's the major driver. I think it's just the fact that there's so much money in the market, and it has, real estate has become a real downer and questionable and not as secure as it was in the past. And the bond market just doesn't give you the returns except in the junk bond market.
Before getting to the junk bond market, you've made the point, certainly for individual investors, you can get a good return. And you mentioned the word 6% on preferreds.
Mm-hmm.
Why 6, not 5 and 7? And how do you get that 6%?
Well, I think the easiest comparison is there that much of the paper that's in the market is around the 6% interest rate, and they trade close to par value, and consequently it's a good midpoint to pick, even though there's many better situations and many less. But I think 6% is a reasonable target without excessive risk.
You seem to make the counterintuitive point of what you might call cushion preferreds. People are reluctant to buy above the par, $25 or $50, for fear if it gets called they have a loss. But you say that very cushion is good security.
Yeah, I wrote a column about this, in fact, in Forbes at the beginning of the year here, and I said that this is a strategy that made a lot of sense to me, because it was effectively short-term paper. And any short-term paper today, no matter which market you look at, 6% is a golden rate of return. So I advocated that. I followed it very diligently with some of my clients, and everybody did very well, because people after a while recognized that this was very much underpriced market and a very low risk type market.
Why have preferreds not gone up even more? I mean, 6% today is like 60% 5 years almost, but that's a fantastic yield.
It is, and I think there's a couple of reasons. One is it's not that well known by the individual investors, and the institutional investors can't really participate in that market, because the average preferred issue is around $100 million, and many are smaller, and not that many are bigger than that. And an institution that needs to trade in $1 million lots and such, they can't buy in that volume, and more importantly, they can't sell if they need to, except over time. So it's really a market reserved, and it was designed for small investors who want to make $25,000, $50,000 investments in those securities.
And so for those kinds of investors, you would make the case that preferreds are better than dividend stocks, although you think there are exceptions, munis and other categories, that's the best for the individual investor these days.
Yeah, we watch the market and the diversity of securities in that market, and we try to stay diversified. So, but one of the things about the preferred market is that it's really quite complex. So we've identified 7 different categories of what's called preferreds, and the majority of the preferreds are actually bonds. They're not stock at all. And then you have your foreign preferreds, which get dividend treatment just like a common stock in the U.S. So So there is a real diversity of selection in it, which is one of the reasons our newsletter is quite successful, because it addresses that market and points out these differences.
In terms of the high yield bonds, junk bonds as we call them, you make again a counterintuitive case that the huge issuance, which some people thought of, oh my gosh, this is a bubble out there. You say, well, in many cases, that's actually a sign of strength. Explain.
Yeah, I do. I think that people aren't doing their homework when they generally malign the high yield market, because they look at the spreads between investment grade and below investment grade in the past, and they say, well, these spreads are so small now that the risk is not counted in. But I think the risk is dramatically changing by all this new issuance, because you have to look at really the purpose for the bond issue, not just who's issuing it. And if a company is issuing high yield bonds at a lower interest rates to replace, for example, existing debt issues or to replace bank loans, that's a tremendous strengthening of the balance sheet, because it gives them more borrowing capacity from the banks in the future if and when they need it and when they can't issue bonds anymore. So their actual survival chances are greatly enhanced by this volume of new issuance. It was the junk bonds were high risk when they were being used to make risky new acquisitions or to buy back stock. But when you're using it to buttress your balance sheet the way it's being done today, I think that is a real positive to the market.
You also make an interesting case, and you cite Bank of America, where the credit rating agencies end up giving a low grade, even though in reality it's investment grade.
Yeah, this is sort of a technical factor that distorts the market, where because somebody like Bank of America that has 4 or 5 tiers of debt, different levels of seniority, those levels are rated by the rating agencies based on their claim in a bankruptcy situation, which would make sense, except if you say, well, Bank of America isn't going to go into bankruptcy, and it's an A rated at the top. So you look at it and you say, well, that's their chance of bankruptcy, which is pretty close to nothing. And therefore, why wouldn't you invest in their lower rated paper? Because you're not worried about their claim in bankruptcy, and you can collect an extra 100, 200 basis points of yield.
So you make the point that in some of these companies, look at what the senior debt is rated at, and that in effect is what you should look at the
well, that's what we tend
debt.
to do. And so, we think that the rating, the idea that the term junk is really detrimental to making an investment decision. They're anything but junk.
High dividend stocks, you think there are some that we should look at. Everyone says go for dividends, but you make the point 2% versus 6%. But there's some like Altria that you think are worth looking at. Are there other ones? Altria, do you still like?
There are quite a few. The tobacco companies are good. Some of the shipping companies, some of the LLPs, and the master limited partnerships. These are all good categories where, especially when you're concerned about interest rates going up, they offer a lot more protection than a fixed rate 30-year bond, for example.
One of the things you make the point in terms of comparing junk and investment grade bonds is that results are skewed because investment grade bonds have a longer maturity than traditional junk bonds do.
Yeah, it's common. That's one of the things we don't tend to look at the maturity of the issues so much, because in the case of high yield bonds, that and in the case of our audience, which is individual investors, they're not buying a bond necessarily to hold it to maturity. They're holding it. They're buying it because it's a good yield now, but their life span is not going to be the length of that bond issue. So they're in a different analysis position relative to what they want to buy.
Municipal bonds, which covers a multitude of
Of sins, yes.
of sins. How do you look at munis today?
Well, for my audience, I've always discouraged them from buying municipal bonds because I think that your investment decision should be based on rates of return that you can achieve. For years I was mystified as to why retired individuals and such who were in a very low tax category were buying municipal bonds. And it finally, somebody finally gave me an explanation of why they do that. And it's basically, they say, I want to simplify my life. I don't want to have to worry about making a tax return and having a big payment in April. I just take all this tax-free income and I don't have to file a tax return and this sort of. Well, that's the worst reason I could think of to buy municipal bonds. And as we've seen over time now that the quality of municipalities is deteriorating significantly, and I don't think the market really reflects that.
Let's quickly hit, because a lot of people do buy these things, even if for the wrong reasons. Mm-hmm. Your quick assessment, Detroit, the proposed settlement there.
I think Detroit is a real beginning of what may turn out to be a wave of similar type situations. There's new ground being broken in terms of Chapter 9 bankruptcies in that case, and a lot of municipalities, I'm sure, are sitting on the sidelines watching this and saying, does this become a viable option to me? But I think more importantly is the fact that for all of these municipalities, the unions, who are usually the major claimants in this situation because of pension and health care unfunded benefits, they need to watch this very closely because we're seeing that their rights are being terminated and having to be renegotiated. And they are going to be much more flexible, I think, to avoid a Chapter 9 bankruptcy than they have been in the past. And so that's probably one of the positives that's going to come out of the Detroit bankruptcy.
Another large issue out there, Puerto Rico. Is that still a wing and a prayer? It's over $70 billion of issuance.
Yeah, Puerto Rico, there's no question that is going to end up as a tragedy. There's no way that they can meet that debt level, and it's only a question of the mechanics of how they basically shorten off the debt there. We see that this last bond issue and the market was very receptive to it, and this was but if you probably looked at who was buying that, it was the people who were looking at that bond issue as generating the funds by which they could make the interest payment on their $70 billion, because the amount that was put out was just about what was needed for that. And I don't know how many times you can play that game, but eventually, even with all the reforms that the new governor is promising, this sort of stuff, it's just gotten way beyond the capabilities of the island to service that debt.
So would you tell individuals, lick your wounds and fight another day?
I would say to them, look very closely at any mutual funds, municipal funds you hold, and how much Puerto Rico paper's in there, because it's going to take a major hit. And same for tobacco bonds.
I was going to ask you about tobacco bonds. Another thing you might say going up in smoke.
Yes, that's one of those that were, the original basis for the issuance of many of these bonds was a study that was done in the 70s when this agreement was reached. Or was it 2000? I forget the year now. But when the original agreement was reached here, some projections about cigarette consumptions over the next 30, 40 years were made. And of course, making a 5-year projection, never mind a 40-year projection, is ridiculous. But the market needs something, and they all signed on to this thing. Now we're seeing that cigarette consumption is dropping at a much greater rate than anybody had projected. So many of these issues, and many of them are zero coupon issues, and consequently, those people are just trading in paper that will never pay off at maturity.
A lot of people live in Florida. What about the so-called dirt bonds?
The dirt bonds, it's kind of a controversial thing there. most of the dirt bonds were bought by mutual fund families, and they didn't do a hell of a good job of scrutinizing.
Just to explain, these are housing development.
Yeah, the community development districts are housing developments where any developer can go out and buy 1,000 acres of land, get a mortgage on it, and get all his money out of it, and then issue a $20 million bond issue or a $50 million bond issue to build the infrastructure. This was going hot and heavy in Florida until 2005, when, of course, the collapse came in the real estate market. And they continued to build out and spend all that money because they'd raised it, and they didn't have any money in the deal. They'd taken their investment out through the bank loans. And so when they finished the infrastructure deal and it got to the point where they would have to start paying the assessments, they all said, no, they let the thing default. And it has been laying in limbo, and you would have thought there would have been a wave of lawsuits as a result of that, but the mutual funds that bought these bonds were still exposed themselves for having bought them in the first place without really doing a good due diligence exam of this thing, because it should have been obvious earlier that this was going to end badly.
So you added up altogether, Detroit, Puerto Rico, tobacco bonds, dirt bonds.
A lot of money.
Munis are a minefield.
Tobacco bonds alone is $100 billion. I mean, that's a huge chunk of the market. Puerto Rico is $70 billion. These are just the big ones, and there are hundreds of municipalities with unfunded pension liabilities and health care who are in the same boat, and just their numbers are smaller.
You mentioned court decisions and the outplay of the Detroit bankruptcy. What do you think for bondholders is going to be the denouement of Argentina? Is that going to make bonding more secure in the future? How do you see that playing out?
Argentina is a difficult one that if they can forestall all their debt service by this default, in a way it takes the pressure off them to have to issue new paper for the time being. So I think it is going to survive the current government, and until Kirchner steps out of that office and somebody can come in with an unemotional approach to the whole problem, I think it's just going to linger there.
But in terms of in the future, of bondholders feeling they're not going to lose, as they did with General Motors, because of politics, is Argentina a ray of hope?
I think that we may see some new Brady bonds come out to solve the Argentine problem.
One of the things you've recommended are ETFs and closed-end funds. Can you give a general description of both categories, why you think they're good for individuals?
ETFs are starting to evolve as good instruments for income investing. They become really a managed, very low-cost managed way of investing in the market, but it's become a minefield. There are so many varieties of ETFs, many of them special purpose vehicles, and in some cases they're created to provide a counterweight to a contract that they hold, where some bank or a large financial institution is holding that contract and expects to make money on it and expects the ETF to take the loss. And therefore you have to be really careful about some of these ETFs. Closed-end funds, it's a different world. There you're buying a management team that's specialist in a particular area, and they represent, because of use of leverage, they give you a very, very high rate of return, often selling at discounts. And in the case of junk bonds, for example, the new issuance junk bonds, they represent the only way to participate in some of these new offerings that are coming out, because all of this volume of new junk bonds is, most of it is privately placed, and that means only the closed-end funds are getting it. So, to participate in that market segment, it's the safest way.
Why do so many sell below net asset value? which is
I
great,
asked-
great for your
I asked-
bargain hunters.
I asked that question many, many times, and I finally got a reasonable answer from somebody about it that makes sense. And their comment was that, for the most part, closed-end funds are not marketed once they're sold. In other words, the people raise their money, they don't have any intention of raising any more, so they're totally exposed to the vagaries of the marketplace. So if you have news come out, for example, about high-yield bonds are a bad place to be, all the junk bond funds get clobbered, and they start selling at discounts until the yield goes to the point where smart money comes in and says, hey, this is the place to buy, and that's I think the traditional curve. It's that there is no business per se behind that. It's just distributions.
What's your outlook on gold, which has been hammered in the last 3 years?
Well, I subscribe to John Malden's publications, and they're very
You
positive.
liked his new book, as I did.
And I think that gold's long-term future is very bright. I think right now, in fact, one of his writers is alluding to the idea that the price of gold to a great extent is being manipulated today by the central banks and such, and that in fact there was some real horror stories about the central banks writing contracts and then they couldn't deliver the gold on it. I think that there is a lot going on with China and such and you can see that it would be very clear motivation for the Chinese to try to diversify out of dollar treasury investments, and so they have to be seriously considering and doing buying the gold bullion per se.
So the day of reckoning is still coming.
Absolutely, it's and for people to think of it, it's disparaged greatly on Wall Street because it takes money out of circulation. When people buy gold bullion, they don't tend to sell it, and then of course that's what you want to do. My biggest concern about gold is that the government will finally recognize that this is a great leakage to their control of the economy, and
So we'll once again repeat of the 30s.
Exactly, that they're going to be banning the ownership of bullion or of bullion coins.
You might get a revolution if they tried that again.
I don't know. There's only here again. It's the number of people who actually own gold don't represent a strong political constituency. The way I mean, if you own a gun, you're much better protected than if you own gold, I think.
Your newsletter, which comes out each month, and you've got a couple of other newsletters as well, ETFs and distressed debt.
Mm-hmm.
On the distressed debt side, have you noticed an uptick on the distressed debt on the municipal side, or is it other than Detroit?
We see the formation of new funds that are investing in this kind of debt because the quantity of distressed debt is increasing exponentially, and so it does represent a much higher yield. I mean, to get Puerto Rico debt, which was up to 7% or 8%, and the rating agencies still rated as, I think, a BBB minus or such. And I mean, which is ridiculous. I mean, the attraction is there, and so there's continued activity in it. But I think it's again an area that unless we get an economic resurgence in this country, I think that we're going to have a wave of municipal defaults.
Richard Lehmann, thank you very much.
Thank you for having me, Steve.